Okay? Okay, so we've done that. Now we're going to talk about taxes in a few minutes. Taxes come in terms of state, federal, and local. Federal taxes are primarily income taxes or profit taxes. So as a business, I mean, most of you have probably had a W-2 form and paid income taxes and so on. Taxes are based on income and profit, not anything else. State taxes are revenue-based. And a good example is sales tax. Sales tax, they don't care if you make a profit or not. They care if you sell something. Federal people, they don't care how much you sell, they care whether or not you make a profit. And so as you plan your taxes, plan them this way. You don't need to plan for sales tax, because sales tax, the customer is going to pay in addition to whatever you make, right? The key thing about sales tax is sales tax, I always recommend you have two checking accounts. One is yours, and the other is the state's. And every dime of sales tax you get, if you sell something for $100 and the tax is $10, and so you collect $110. $100 is going to go over here, and $10 is going to go over here. It should never enter your checking account. It should be kept separate because this belongs to the government. You are no more than a tax collector for them. Local tax is a portion of the sales tax.
One
Yes.
thing that we had it was kind of confused when we started to find out who should we charge, and then we learned that being a company that provides service, not a good, like you explained earlier, then we cannot apply the sales tax.
Okay, who told you that?
An accountant.
Okay, the way you should find that out is you should call the Washington State Department of Revenue.
Mm-hmm.
The Department of Revenue is a very, very nice, helpful group of people, and you should call them up and say, this is my business, this is what I do, and they will tell you, okay?
Okay.
To say you do a service or don't do a service is a little bit misleading because some services are taxable, some are not. I'll give you an example of one of my clients about a year and a half ago. She paints, right? Mm-hmm. If she paints the side of the house, that's a service. But one of the things she paints every once in a while is she paints those neat pictures on the side of the fences that go around construction sites. That's taxable. Okay? So, if she just paints it white, it's one thing. If she paints it and it's got a picture on it, it's a completely different thing according to the state. So, if you have questions about what's taxable and what's not, and everybody should go through this process at least once, call the state, this is the business I'm in, tell me if it's taxable or not, and tell me why. Okay?
It's confusing.
How bad can we get, like, when you're not making, you know how the federal tax is based on profit?
Yep.
Right, so if your business isn't making profit,
You don't owe them a dime.
You don't pay tax.
You don't pay any taxes.
okay, how long could that last?
Forever.
Yeah.
I have a corporation that since 1987 has not made a profit. I file my tax return every year, and the government says that sounds fine. They don't look for any money. Why do I keep the corporation around? For a different kind of a tax reason. And so we're going to get into that for just a second.
Because I'm asking because I have a person that does my taxes, and for my business hasn't made me a profit, and but she says like I can get penalized for
For not making a profit?
yeah.
No, you cannot get penalized for not making a profit.
If you're claiming deductions though, and I've heard something similar, that if you claim deductions that are over any profit that you make for like 5 years or something, that you have to.
If you declare a loss for multiple years in a row.
Thank you.
Yeah. You know, it depends. It depends on what so I have a small business and I calculate a loss every year for the past 3 years, and I'm kind of piddly according to the IRS. They're like, they're not looking at me. One of the services we offer is bookkeeping and business coaching. That works with you on that. So, but I've seen our clients declare losses for at least 3 years, especially micro businesses, no problem. So, that's why, so we run tax workshops that are open to the community, small business tax workshops, Schedule C for sole proprietors, every year. So we'll make sure you guys have that information to walk through Schedule C. But we've never had, from the clients that we've worked with, we've never had that multiple years of losses signal anything.
Okay? Now, where people get into problems is where in their books they don't show a profit, but in the government books they do show a profit. Okay? So, let's take an example. Business brings in $10,000, right? Business pays you $8,000 and pays somebody else $3,000, right? Then it looks to me like you lost $1,000, right? That's what it looks like. But this amount here that it paid you, who's paying taxes on that?
Me.
Have you paid the taxes on this? That's the question. Oftentimes people will say, well, that's an expense to the business, and therefore I don't have to pay taxes on it because I didn't make any money. But from the government standpoint, they look at this as saying, you brought in $10,000, you had $3,000 worth of expenses, therefore you had $7,000 worth of profit that you had to pay taxes on. Even though the business lost $1,000, there was a $7,000 profit to the government's. Because your wages are not a deduction to your business in a proprietorship. Okay? So yeah, you can get into trouble, but you have to make sure what you know is the way the government thinks, not the way your business looks. Okay? Make sense?
The same for LLCs?
Pardon me?
The same for LLCs?
LLC has two different methods of taxing. They can be taxed as an independent entity, or they can be taxed as a single member LLC on your standard 1040 tax return. So you make that election when you do this if it's a single member LLC, and then given that election, you may work this or you may not. If your election is an independent entity, then that means that you will pay salary to you with the W-2 standard system, and then from a business standpoint, there is a loss, but they still get their money because they get their money from you because you get it as salary. So the government doesn't care which way they get it as long as they get it. That's what they're talking about. Okay. So in this case, I want to just mention something. We're 10 minutes over. Again, I'm going to give you guys the offer. If you want to leave at this point, feel free. I'm going to continue talking until there's no people still sitting, and so you can listen as long as you want. So in this case, one of the things that you want to do is you want to minimize your profit. by spending the same amount of money. So, let's take the example of rent. Right? If you have a house and you dedicate a portion of that house to the business, it becomes a deduction and therefore can be taken off of the total tax between you and the business. Okay? So you want to increase your deductions as much as possible to make sure that the total amount of income between you and the business is small. The example I almost always give in this situation, I have a piece of commercial property in Dallas, Texas. My daughter went to college in Dallas, Texas. Every time it was about the time for my daughter's birthday, I had to go see my business property in Texas to make sure it was okay.
Yeah, that was good.
So the plane flight, the hotel, the rental car was all a tax deduction for me because I was doing business work. The fact that I happened to see my daughter at the same time was irrelevant. And the government buys it. It's okay. It's money I was going to spend anyway. It's just, do I pay taxes on that money or do I not pay taxes on that money? Because it was a business expense, there is no tax paid. Yes?
That's, oh, I'm sorry.
So if I wanted to get a new car, like a production vehicle that's like bigger than the one I have now, then that could be, like if I'm like driving it around for my own purposes, like to get groceries or whatnot.
So you have opened up a very interesting can of worms that we need to address, and that can of worms is car expenses. Okay, there's two ways to do cars. One way to do cars is more complex and more difficult, and that is on a cost basis. So let's say you have a car and 50% of your mileage is for yourself and 50% of your mileage is for the business. Then if you spend $3,000 on insurance for that car, then $1,500 of that is a business expense and therefore tax deductible for the business because 50% of the mileage is a tax deduction. That's absolutely true. And every dollar you spend on that car can be split 50-50. Your oil change, your gas, everything gets split 50-50, and 50% of anything you spend you can deduct. That's one way to do it, and that's perfectly acceptable. And some people will have their own personal car and a second car, and it becomes even easier at that point because they say, this is the car I drive for personal miles, and this is the car I drive for business miles. Okay? In addition, so the second big thing in car expenses is how do you calculate what is business mileage and what is not? I live here, I work here. I drive from where I live to work and I drive from work back. That is not business mileage. Because if this was a job that you worked for somebody else, you would spend that same amount of money to get to work and get back from work. So these miles are not okay. However, if there is a store here that you happen to buy something before you go to work, 100% of all these miles are deductible. Because this was a business trip. You weren't going to your place of work, you were going to do something for the business right from home, and therefore it is business mileage. Everybody see the difference there? Okay.
Yeah.
Second thing, cost basis is an awful lot of bookkeeping. So the government gives you a better way to do that, and 54 cents for every business mile you drive is a tax deduction. 54 cents for every business mile you drive is a tax deduction. All you have to do is document what the purpose of that business trip was. And you just keep a book in your car or a piece of paper in your car and say, Mileage A, start. Mileage B, end. Went to the store. Mileage A, start. Mileage B, end. Lunch with John Smith, who is the manager at MGM Studios. These are the things that are business mileage, and this is generally much easier for people to do than to keep the 50-50 thing split out, because it doesn't matter. When I was running my businesses, I was driving 20,000 miles a year, and this paid for 120% of my car.
Alright.
Yes?
Some people will rather, instead of buying a car, they rent a car because that's something that, like the lease a car, because that's something that you can write off directly. Is that right?
Yes? Do I recommend that?
I don't know, I'm just,
I mean, the idea of leasing is an idea which says that if I buy a car and I've got payments, then all I can deduct really is the interest, and then I have to worry about how much I bought it for and how much I sold it for. A lease is much cleaner. This is how much, and that much of the car has gone away, because that's what the lease says. This is the residual value at the end, this is what it costs per month, and it's a very clean deal. I don't lease cars, and I don't lease cars because I do much better this way on my own car.
okay. And you never own it. Besides the fact that you will never own it.
That's right, okay?